What if the United States just lost control of $6.1 trillion in global trade, without even realizing it? On May 26, China didn't fire a missile or send troops. Instead, it issued a quiet directive. Banks were to cut back on dollar-based transactions and pivot to the Yuan. Overnight, countries began pricing oil, steel, and machinery without touching the US dollar. While Washington demanded Beijing reduce exports, China drew its line in the sand. We'll trade, but only on our terms. This isn't a tariff dispute, it's a financial revolt, and the next steps could permanently weaken America's hold over the global economy. That same day, the People's Bank of China raised the minimum Yuan ratio in cross-border deals from 25% to 40%, effectively sidelining the dollar in transactions worth more than $6 trillion annually. This wasn't symbolic. Chinese banks that failed to comply face regulatory downgrades and restricted market access. Goldman Sachs now projects that every 1% rise in the yuan could lift Chinese equities by 3%, a signal of the seismic financial weight behind the move. At the Global Finance Forum, U.S. Treasury Secretary Scott Bessent accused China of destabilizing trade and demanded it scale back manufacturing. Beijing didn't flinch. Instead, it doubled down, rolling out a made-in-China reboot focused on AI, robotics, and semiconductors. Manufacturing contributes 25% of China's GDP, and officials made it clear that number isn't up for negotiation. Unlike Washington's binary view of produce less, consume more, Beijing is expanding both sides, and as long as that expansion is denominated in yuan, U.S. influence over trade weakens further. This isn't a tantrum, it's structural. By forcing trade into yuan, China shields itself from dollar sanctions while pulling global capital toward its markets. In Q1 2025, yuan settlements made up 30% of goods trade, up from under 20% just 2 years ago. Analysts estimate that shifting another 10%, about $610 billion, into yuan could raise demand for Chinese assets by 12%. The result? Less recycling of dollars into U.S. treasuries, tighter Wall Street liquidity, and a growing global incentive to hedge in yuan. But China's real power lies in who's joining this shift, and who's ignoring Washington. Imagine shopping in Johannesburg. You pick up a generator. Chinese-made, cost-efficient, priced not in dollars but yuan. That's reality. In Q1 2025, China's trade with BRICS reached 1.49 trillion yuan, $209.7 billion, up 11.3% year-on-year. Deals with South Africa, Iran, and Brazil are increasingly settled in local currencies or yuan, bypassing the dollar altogether. Meanwhile, Trump's tariff hikes, now at 145%, are driving even U.S. partners to look for alternatives. The dollar is becoming not just politically toxic, but economically inefficient. China's exports tell the story. In Q1 2025, shipments to Brazil jumped 25.7%, imports rose 30.1%, and trade with Russia surged, especially in energy and machinery. Why? Predictable pricing, fewer political strings, and UN contracts that avoid US blowback. Officials now say BRICS accounts for 20% of global goods trade, an accelerator of de-dollarization. And while Washington talks of Fortress America, China is using scale and state leverage to sharpen its edge. When Trump raised tariffs, Chinese machinery exports didn't collapse. They surged 18.4%. Firms like Sany and XCMG redirected capacity from China's cooling real estate sector to overseas markets, undercutting competitors by up to 50%. Contracts priced in yuan bypassed tariffs altogether. Instead of breaking under pressure, China grew stronger. So, if the yuan becomes the new default for trade, what happens to the dollar outside U.S. borders? By April 2025, over 40% of BRICS trade was settled in yuan, up from 29% the year before. The UAE and Egypt, new BRICS members, are signing infrastructure deals in yuan, while Saudi Arabia is reportedly reviewing yuan-based oil contracts. The appeal is obvious: faster settlement, fewer restrictions, and protection from U.S. sanctions. Beijing is dismantling dollar dominance without confrontation, by building an alternative system. More than 60 countries now use China's cross-border interbank payment system, CIPS, which saw transaction volumes jump 27% year-on-year by March 2025. This network mirrors SWIFT but clears payments in yuan, shielding partners from dollar volatility and U.S. oversight. At the same time, China's sovereign digital currency pilot expanded to 14 new trade zones, making transactions faster and harder to trace through Western institutions. This isn't protest, it's infrastructure. And every transaction outside the dollar weakens it, not through sanctions but through obsolescence. Wall Street depends on global demand for dollars. But if trade migrates to yuan, capital will follow. A 10% increase in yuan-denominated trade could cut foreign demand for U.S. treasuries by $210 billion annually. Bloomberg reports Asian institutions already reduced U.S. debt holdings by 12% in Q1 2025. Central banks from Indonesia to Iran are raising yuan reserves. This isn't just currency competition, it's a shift in financial trust. If dollar reserves no longer mean guaranteed access or stability, the world will seek new anchors. And if Wall Street isn't that anchor, what takes its place? China isn't waiting for permission, it's writing its own rules. Phase 1 was sidelining the dollar. Phase 2, leaked memos suggest Beijing could soon tie its digital currency directly to trade pricing, locking in buyers and cutting out foreign exchange markets altogether. That's not just monetary policy, that's financial engineering on a global scale. If you think the hard part is over, think again. The harder shift is only beginning. We're glad you're watching Geoscope. Like and subscribe for more. Dollars.